Hey everyone, and welcome back to the channel. Today, we're tackling something that's been making big waves in the financial news, Moody's recent downgrade of US government debt. You might be hearing a lot of scary headlines, but what does this really mean for your money, your investments, and the future of the American economy? Is this a sign of economic collapse, or just a lot of noise? I'm going to break down exactly what happened, what history tells us about these kinds of events, and the most crucial thing you need to understand about the US dollar's role in the world. Trust me, you'll want to hear the full story because I'll reveal the single most important takeaway for your portfolio at the very end of this video, so make sure you watch until the end. Let's get straight into it. So, Moody's, one of the big credit rating agencies, recently lowered its outlook on US debt. They're joining the club with other major agencies like Standard & Poor's and Fitch Ratings, which already downgraded US debt years ago. Standard & Poor's did it back in 2011, and Fitch followed suit in 2023. Why are they doing this? The main reason is pretty straightforward. The US government has been racking up massive debt and interest payments for over a decade, reaching levels significantly higher than other countries with similar credit ratings. Year after year, Washington has failed to agree on serious plans to reduce these growing deficits. Instead of passing a real budget, Congress has often opted for short-term funding bills that keep increasing spending, almost doubling it every 9 years. This unchecked spending has led to a national debt that just keeps growing. Now, here's a critical point that many headlines miss. A debt downgrade like this does not cripple the US dollar's status as the world's reserve currency. It also doesn't stop US Treasury bonds from being the gold standard for risk-free investment globally. Think about it. The US can print its own money, so it can always avoid a technical default. That's why US Treasury debt will still be considered the safest asset in the world, no matter what these ratings say. As one expert put it, it's ridiculous that other countries might have higher ratings when they depend on the stability the US provides. But does this downgrade still mean trouble for your investments? Let's look at history. This isn't the first rodeo for US debt downgrades, and that's actually good news for understanding what comes next. Back in August 2011, Standard & Poor's downgraded US debt from its top AAA rating. The headline screamed doom about a collapsing dollar, economic demise, and a stock market crash. What actually happened? The stock market had rallied sharply before the downgrade and was a bit overbought, meaning prices had gotten ahead of themselves. When the downgrade hit, along with other global economic issues, prices did correct. But here's the kicker. That decline quickly turned into a buying opportunity, and the bullish trend for stocks continued into 2012. And what about bonds? Treasury yields initially spiked, shaking investors. But because US Treasury bonds are still considered the world's ultimate safe haven, yields actually declined into 2012. This is because as more debt is issued, economic growth tends to slow down, which ultimately puts downward pressure on interest rates. Many so-called bond gurus get this wrong, expecting rates to skyrocket, but the reality is the economy can't sustain super high rates because of the sheer amount of debt. Fast forward almost exactly 12 years to August 2023, and Fitch Ratings followed suit, downgrading US debt for almost identical reasons, primarily the government's ongoing inability to manage its long-term debt issues. US Treasury Secretary Yellen even pushed back, calling Fitch's analysis flawed and outdated. Just like in 2011, the stock market initially sold off after the Fitch news, but experts noted it had more to do with an artificial intelligence trade that had gotten way too high, and the downgrade simply provided a catalyst for a needed correction, not the underlying cause. The bond market also saw an initial sell-off and higher yields, but this quickly reversed. So, if past is prologue, what should we expect now? I'm going to tell you how this applies to your stock and bond investments next, and why the longer-term picture for our economy, as revealed by government reports, is even more important. Given what we've seen from previous downgrades, Moody's recent action is largely meaningless in the long run. Nearly 15 years after the first major downgrade, the US dollar is still the world's reserve currency, and the economy didn't collapse under the weight of the debt. Investors who bet against those doomsday predictions were well rewarded. So, what does this mean for stocks and bonds in the coming months? For the stock market, we entered this latest downgrade with stocks again in overbought territory, meaning they'd risen significantly and were due for a breather. Just like in 2011 and 2013, the market was in a similar position during previous downgrade announcements, leading to a short-term correction. It's common for an aggressive market to need an external, unexpected event to bring in sellers. This downgrade could be that catalyst for a short-term pullback. But here's the key. This pullback will most likely be an opportunity for investors to increase their stock exposure. The long-term bullish trend for the market remains intact as long as it holds key support levels. For the bond market, yields pushed higher leading up to the announcement. Again, history suggests that while yields might initially rise on the news, the fundamental economic forces, like slower economic growth, stagnant wages, and falling inflation, will eventually drive yields lower. Plus, there's a big factor coming up. U.S. bank regulators are getting ready to ease capital requirements for banks, especially related to the supplementary leverage ratio, or SLR. Why does this matter? Because the biggest banks, which are the biggest buyers of U.S. Treasury bonds, have been saying that these rules limit their ability to buy more Treasuries. If these restrictions are eased, banks will be eager to buy more government bonds. Plus, with a huge number of people bidding against Treasuries right now, this could lead to a significant drop in bond yields and a rise in bond prices, especially if the economy slows down or the Federal Reserve starts cutting interest rates. Now, to the important takeaway I promised you, and why it's crucial to understand the bigger picture of our national finances. The debt downgrade is one thing, but it ties into a bigger ongoing challenge, the federal debt ceiling. This is a legal limit on how much the U.S. government can borrow. It's been raised or adjusted about 100 times since it was established. When the government hits this limit, the Treasury Department uses extraordinary measures, essentially accounting maneuvers, to delay running out of cash. These measures buy time, but they're not a permanent solution. If Congress doesn't act to raise or suspend the debt ceiling, the government wouldn't be able to issue new debt and would only be relying on incoming tax revenues to pay all its bills. This is where it gets serious. If the government can't pay its bills, that means things like Social Security payments, military salaries, and even interest payments on the national debt could go unpaid. A default, or even the threat of one, could have disastrous effects. Global financial markets would be in chaos, interest rates across the economy would rise, affecting your car loans, credit cards, mortgages, and the value of investments like Treasury bonds would drop. The good news is that Congress and presidents have always found a way to avoid a default, even if it's at the very last minute. They often use these moments to push for broader deficit reduction plans. While waiting until the last minute can still cause market jitters and increase borrowing costs for the government, a full-blown default has been avoided every time. Looking ahead, the Congressional Budget Office, a nonpartisan group, projects that U.S. economic growth will slow over the next 3 decades, largely due to weak population gains and continued high government spending. Publicly held debt is expected to remain very high compared to the size of our economy. This isn't just a number. It means slower improvements in living standards and difficulty funding vital programs like Social Security. So, here's the most important takeaway for your portfolio. While the long-term implications of our national debt are concerning, the Moody's debt downgrade itself is not a reason for immediate panic for investors. History shows these downgrades often present opportunities contrary to what many expect. The current market conditions, including overbought stocks and temporarily elevated bond yields, suggest that we might see a short-term pullback in the stock market. The media will likely blame it on the downgrade, but it's more about the market needing to cool off. This correction, if it happens, will be healthy and provide better opportunities to increase your stock and bond investments. Don't let the headlines scare you out of smart investing. That's it for today's market update. If you found this information helpful, please hit that like button, subscribe to the channel for more insights, and don't forget to ring that notification bell so you never miss a video. Thanks for watching, and I'll see you next time.